Okay, now we're into week 2 of corporate finance. So should we talk a little bit more about corporate finance? So corporate finance is where we evaluate our economic resources that are required to establish and maintain a firm. So that would include funding and to enable purchases of material and other things. It would also allow funding for the workforce and assembling workers and hiring people. And of course, obviously, we need some long-lived assets or some capital assets, such as equipment or building. The balance sheet gives us the idea here, so we're going to work with the balance sheet with regard to what corporate finance is all about and how it looks at the different aspects of finance within a business. So if we look at the balance sheet and the balance sheet model of the firm, we can see that there's two sides. Of course, we know that there's one side that's the assets of the firm, that's current assets, either fixed assets or current assets. And then we have the firm value to the investors, which is current liabilities or short-term liabilities, as well as long-term debt or long-term liabilities, and also shareholders' equity. So if we take the balance sheet equation, we have one side that has funded the organization, we have the other side with what the funds went to. So we have liabilities, which is short-term and long-term liabilities. So we have borrowed money from people, either bondholders or just short-term credit bills that we owe, liabilities that we owe. And that's one part of the funding of the organization. The other part, of course, is equity. We've put our own money in, or shareholders have put their money in, so we have equity. And equity is another word for ownership. So we have ownership of the company itself, and then, of course, we have lending. People have borrowed from the company. That's one side of the balance sheet. The other side of the balance sheet is, where did that money go? Where did that money go? So if we have money from liabilities and money from equity, or debt and equity on one side, the other side is what did we use them for? And of course, this is where corporate finance comes in, is where do we get this money, and then what do we do with it? So the next slide, it talks about the three concerns of corporate finance. The first one is, what long-term investments should the firm choose? The second question is, how should the firm raise funds for the selected investments? And 3 is, how should the current assets be managed and financed? So let's take these in order. So the first question is, what long-term assets or investments should the company choose? And if you see the slide, we're talking about fixed assets here, tangible or intangible. And so what we're looking for is, how much money do we need to raise for major purchases? Do we need a building, or can we rent a building? Do we need a piece of equipment, or can we rent a piece of equipment? If we need to purchase these things and we need to raise money for these things, then clearly we need to raise significant amounts of money. The other thing could be intangible things that are need to be done, and that would be drugs in a pipeline and other things. These are things you would want to know about funding for before you even started the company. The second thing that we're looking for is, how should we raise these funds? So we've decided how much that we need to raise, so much for fixed assets, and so how much should we raise, and how should we raise it is even a better question. So do we borrow from debt holders? How much do we borrow from debt holders? Or do we have an all-equity firm? If we have an all-equity firm, we of course can't go bankrupt because we don't owe anybody any money. No firm that goes has no debt could go bankrupt, as bankruptcy is a debt proceeding. But we don't always want an equity firm. As you know, debt is leverage. So when we start thinking of debt as leverage, we can magnify our returns if we have some debt in the firm. We've seen this in other slides already. I won't go into it, but debt being leverage, you want to have some debt in the firm, but not so much debt that the minute that something goes wrong, that you go underwater and the firm's at risk. So it's a balance between debt and equity. Very difficult decision in some cases. Obviously, most corporations are fairly secure on how much debt they have and how much debt the market is willing to lend them. How much in the bond market the interest rates are will tell you how much the market is willing to lend you money. So you have debt and you have equity on that side. So we have, what are we going to buy? What do we need to raise money for? That's the first thing. Second thing is, how are we going to raise the money? And the third thing is, then how do we manage the day-to-day operations? And that third thing is basically cash management or net working capital. So we started thinking about this in terms of our current liabilities and our current assets. We clearly have to have money in the bank or in liquid assets to pay our current liabilities. In other words, we need to be able to pay our bills. but we also need to have current assets to fund operations and continue the company in good working order. So net working capital is something we definitely have to have, and we'll talk about more of that coming up. But so, what do we need to buy in capital goods? Then how much in capital fixed assets, and then how do we fund it with debt and liability and debt and equity? And then the third thing is how much working capital, how much net working capital do we need to fund operations? And net working capital obviously is going to grow with the company. A company that has $1 billion in revenues and size is going to have much more working capital than someone who has 100 million or even 100,000 in revenues. So the amount of net working capital is going to grow with the company as the bills are going to grow, the size is going to grow, and so on. So let's take those three questions and turn them into the role of the financial manager in the next slide.